The year was 1971. The world believed its money was backed by gold, but that was a carefully constructed lie. For decades, the United States had promised nations that their dollars were as good as gold, $35 an ounce, a sacred covenant. But behind the closed doors of the White House, a secret memo was circulating. It outlined a terrifying reality. America was running out of gold. The promise was about to be broken. The system was bleeding to death. President Nixon's inner circle knew the truth. They weren't just facing an economic problem, they were facing a run on the bank, and the bank was the entire United States. Foreign governments, led by Francis Charles de Gaulle, were calling America's bluff, sending ships to New York to demand physical gold in exchange for their paper dollars. The vaults at Fort Knox were being emptied. They had to kill the system before the system killed them. On August 15, 1971, Nixon went on television and performed the single greatest act of financial magic in modern history. He temporarily suspended the convertibility of the dollar into gold. The temporary measure became permanent. The world's currency was no longer anchored to anything real. It was now a faith-based system built on the full faith and credit of the U.S. government. The price of gold, the ancient symbol of wealth, was now a political instrument, but the genie was out of the bottle. A system built on trust can be broken by fear. With the gold window closed, a new problem emerged. If gold was no longer the official anchor, what would stop its price from soaring? A rising gold price would be a signal to the world, a flashing red light indicating a loss of confidence in the US dollar and the management of its economy. It would signal inflation, weakness, and instability. The market couldn't be allowed to decide what gold was truly worth. The solution was not to fix the underlying economic problems, but to manage the signal. The stage was set for a quiet war, a decades-long campaign to suppress the price of gold. The first major front opened in the 1970s. The U.S. government, now holding the world's largest stockpile of bullion, began a policy of strategic gold sales. The message was simple. If the price started to climb, the U.S. Treasury would flood the market, increasing supply and beating the price back down. It was a show of force. They had to control the narrative. But this was a blunt instrument. As inflation exploded later in the decade, hitting double digits and creating lines at the gas pump, the public's desire for gold became a frenzy. The price exploded from the official $35 an ounce to over $800 by 1980. The manipulation was failing. A more sophisticated, less visible tool was needed. The real manipulation was about to go underground. The 1990s saw the birth of the modern scheme. The key innovation was something called gold leasing. Here's how it worked. Western central banks, sitting on thousands of tons of dormant gold in their vaults, would lend this gold to large bullion banks at meager interest rates around 1%. This seemed like free money for the central banks, but the purpose was not to earn interest. The bullion banks would immediately take this physical gold and sell it on the open market. This massive, constant flow of supply, gold that no one knew was available, acted as a permanent ceiling on the price. It created the illusion of abundance, but this created a phantom liability. The gold had been sold, but it was still listed as an asset on the central bank's balance sheet. The physical metal was gone, replaced by a paper, IOU. They were selling what they didn't own to hide what they had done. The ledger became a hall of mirrors. This is where the story splits in two. On the surface, you had the paper gold market, the trading of futures contracts on exchanges like the COMEX in New York. The volume of paper gold traded every day dwarfed the entire world's annual mine supply. The price was set in this paper casino, and the bullion banks had a powerful weapon. They could sell massive amounts of gold futures contracts they didn't have, a practice known as naked short selling. This would instantly flood the market with sell orders, driving the price down before anyone could react. The tail was wagging the dog, but beneath the surface, a physical drain began. The cheap gold from this manipulation was snapped up, not by Western speculators, but by the rising economies of the East. The central banks of China, Russia, and India, along with millions of their citizens, saw discounted physical gold as the ultimate form of savings, immune to Western financial engineering. They were buying the metal and taking it home, melting it into bars and jewelry, and removing it from the system forever. The West was trading its real treasure for paper profits. The system depended on one thing, that the physical gold would never be demanded back. It was a fractional reserve system for gold, just like the banks had for dollars, and like all such systems, it was vulnerable to a run. The first major crack appeared in 1999. The price was languishing around $250, a 20-year low thanks to relentless manipulation. But the Bank of England decided to sell a huge portion of its national gold reserves at this rock-bottom price. A nation was liquidating its heritage at the worst possible time. The decision was so financially disastrous that it could not have been mere incompetence. It was political. The UK was helping its ally, the United States, maintain the dollar's supremacy by suppressing the gold price. The British public was never told the true cost of this allegiance. The move was so blatant it sparked outrage and led to the first Washington Agreement, where European central banks promised to limit their gold sales. The conspirators were being forced to show their hand. Every manipulation sows the seeds of its own destruction. The 2008 financial crisis was the earthquake that shook the foundations of the entire scheme. As the world's largest banks teetered on collapse, the bullion banks that had been shorting gold found themselves in a catastrophic position. The price, instead of falling in a panic, began to rise. People were fleeing paper assets and seeking safety in gold. The manipulators were caught on the wrong side of the trade. They were staring into the abyss to avoid a market meltdown where the inability to deliver physical gold would be exposed. The U.S. government facilitated a series of secret, undocumented bailouts. The U.S. Federal Reserve opened swap lines with other central banks, and it is widely believed that gold swaps were a key part of this package, shipping physical gold to New York to placate the rising demand for delivery without moving the public price. The system survived, but the strain was evident. The dam was cracking. In the years that followed, the evidence mounted. Whistleblowers from within the banking system came forward. A commodities trader named Andrew Maguire testified to the CFTC about watching a massive, short order for gold futures get placed in the middle of the night with no economic purpose other than to smash the price right at the London Open. He provided dates, times, and amounts. The regulators did nothing. They were not just complacent, they were complicit. Then came the class action lawsuits. One of the most famous filed against several bullion banks alleged an explicit multi-year conspiracy to manipulate the gold price. The evidence was in the trading data, countless instances of massive sell orders hitting the market at key times, specifically to break rising momentum and trigger preset stop-loss orders. It was a systematic effort to control the most ancient measure of value ever created by humankind. The proof was in the pattern. But the most damning evidence is not in a courtroom or a whistleblower report. It is in the great divergence, the ever-widening chasm between the paper gold price set in the futures markets of New York and London and the physical gold price demonstrated by the relentless accumulation of metal by Eastern central banks. They are buying not for a short-term trade, but for a long-term strategic shift. They are preparing for a new financial world order. The East is hoarding the very asset the West is trying to devalue. This is the final act of the secret plot. The manipulation has been so successful for so long that it has created the conditions for its own catastrophic failure. The physical gold is moving from the vaults of the West to the strong rooms of the East. The paper claims on that gold, the futures contracts, and the ETF shares now vastly exceed the available physical metal to back them. A single demand for delivery could break the entire system. We are now witnessing the endgame. The confidence trick that began in 1971 is reaching its mathematical and logical conclusion. The central banks of the West, having leased and swapped their gold, may now find their vaults dangerously empty. The price you see on your screen is a phantom, a relic of a paper game that is about to end. When the music stops, the scramble for the last remaining bars of real metal will be the final brutal chapter. The lie is about to be called. The trigger will not be a single event, but a cascade of failures. A major bank unable to fulfill a physical delivery order. A sovereign nation, like China or Russia, publicly declaring its true gold holdings, revealing a figure far beyond Western estimates. Or a sudden, coordinated move by several nations to settle international trade in a gold-backed currency, completely bypassing the dollar. The warning signs are already flashing. Look at the recent behavior of the central banks. Since 2010, they have shifted from being net sellers of gold to being net buyers. And not just any buyers. The buying is led by nations explicitly seeking to de-dollarize the global financial system. Russia, sanctioned by the West, sold its U.S. Treasury bonds and tripled its gold reserves. China, notoriously secretive about its acquisitions, has been steadily adding to its stockpile for years, likely making it the world's largest holder. They are building a lifeboat out of real money. This is not an investment strategy. It is a strategic geopolitical maneuver. Gold is the only financial asset that is no one else's liability. It is the ultimate form of monetary defense. While the West was busy creating complex derivatives and digital tokens, the East was accumulating the one thing that cannot be hacked, inflated away, or defaulted on. They learned the lesson of 1971 that the West has forgotten. The foundation of the dollar's dominance is cracking. The manipulation of the gold price was never just about making money for a few connected banks. It was about maintaining the exorbitant privilege of the US dollar. A soaring gold price is a vote of no confidence in the management of a currency. It screams inflation and fiscal irresponsibility. By capping the price, the powers that be could create the illusion of stability, allowing them to run massive deficits and print money with impunity. They traded long-term survival for short-term control. But the laws of economics are like the laws of physics. They can be ignored for a while, but they cannot be repealed. The sheer scale of money printing since 2008, and especially since 2020, has been staggering. Trillions upon trillions of new dollars have entered the system. The manipulation has contained the symptom, the gold price, while the disease of currency debasement has run rampant. The pressure in the system is now critical. The dam cannot hold against a tidal wave of paper. So, what happens when the manipulation finally breaks? The first sign will be a decoupling. The price of physical gold in the form of bars and coins will begin to trade at a significant and permanent premium to the paper gold price. This is already happening in small, localized ways. When a full-scale break occurs, the paper market will become irrelevant. The ticker on the financial news channels will be a ghost, a fantasy number that no one can actually transact at for physical metal. The two prices will violently divorce. Then comes the delivery failure. A major institution, perhaps an ETF like the GLD or a futures contract on the COMEX, will announce it cannot deliver the physical metal to a holder who has demanded it. The run on the physical gold bank will begin. Every holder of a paper gold claim will rush to exchange it for the real thing before the doors close. But there is not enough real thing to go around. The music has stopped, and there are 100 dancers for every chair. The result will be a price discovery event unlike any in history. The suppressed price of gold, held down for decades by artificial supply, will explode upward to its true market clearing level. This is not about predicting a price of $5,000 or $10,000 an ounce. This is about the remonetization of gold. When it reassumes its role as the ultimate measure of value, its price in rapidly depreciating paper dollars will be almost unimaginable. The reckoning will be mathematical, not speculative. For the ordinary person, this is not a distant geopolitical drama. It is a direct threat to their savings and their standard of living. The value of their cash, their bonds, and their pensions, all denominated in a system of manipulated paper, will be dramatically eroded in the ensuing financial reset. The winners will be those who hold physical gold outside of the banking system. The losers will be those who trusted the paper promises. Your wealth is the stake in this hidden war. So, what can you do? The actionable insight is not to try and time the collapse of the manipulation, which could persist for years in its death throes. The insight is to understand the fundamental pattern and act on the underlying truth. The first step is to take possession of the one asset that is both the target of the manipulation and the key to surviving its failure, physical gold itself. Own the metal, not the promise. This means buying real, tangible gold coins or bars from reputable dealers and storing them securely, outside of the mainstream financial system. Do not confuse this with buying a paper gold ETF, a futures contract, or a bank-issued certificate. These are the very paper claims that will be exposed when the system breaks. You must hold it in your hand. You must have direct, unencumbered ownership. If you don't hold it, you don't own it. The second step is to understand that this is not a short-term trade. It is a long-term insurance policy against the failure of a system. Allocate a portion of your wealth to this physical insurance and then ignore the manipulated paper price. Its daily fluctuations are noise, a magician's trick to distract you. The real story is the quiet, relentless movement of physical metal from the weak hands to the strong. The East understands this. You must, too. The secret plot to manipulate gold prices is the financial story of the last half-century. It is a story of how a few powerful entities attempted to suspend the natural laws of economics to preserve their own power. They created a fantasy of perpetual stability, a world where debt had no consequences and money could be printed without cost. But that fantasy is colliding with reality. The truth is always traded for a lie. The manipulation is a dam made of paper, and the water is rising. The plot is unraveling in plain sight, in the divergence between paper and physical, in the frantic buying of sovereign nations, and in the unsustainable debt loads of the manipulators themselves. The final chapter of this story is not written, but its trajectory is clear. The system will break. The only question is whether you have positioned yourself on the side of reality or on the side of the fading illusion. The greatest transfer of wealth is imminent. When the world realizes that the price was a lie, the truth will be priceless.